With all the political and macroeconomic change that we've seen in 2025, many Canadians are wondering if they should own U.S. securities, stocks, bonds at all in their portfolios. Today, we're going to touch on this question amongst a number of others, including what have returns been on various assets in 2025? Is inflation back? Is the U.S. in trouble? What's happening with the AI boom? And should we be worried about hitting all-time highs in the stock markets? Cary Williams here, North Road Investment Counsel, Portfolio Manager. I'm joined by my colleague, Marshall McAllister, President and Portfolio Manager at North Road Investment Counsel. We are going to start right away into this mid-year review because we have a ton to go through. Marshall, I'm going to share my screen. Why don't you get us started on an update with the firm, and we'll go from there.
Thanks, Cary. Great to be joining you here today. We've had a lot of fun coming to work this last couple of quarters. Most importantly, a day at the lake last week where we got to play bocce ball and goof around at Lake Wabamun. So I know that was a lot of fun for everybody. We thankfully have been able to grow our team, and I just wanted to spend a couple of minutes talking about who are the latest North Road team members. And I'd like to start to introduce Brenda Gonzalez. Brenda has started with North Road at the back end of 2024, and Brenda is our controller at North Road, and she is supervising our relationship with our accounting team as well, looks after payroll, some benefits, and some of the things that you and I had to do, Cary, in the first couple of years of our firm's existence, and couldn't be happier that Brenda's on our team and taking some of those duties off of our hands. The next team member I'd like to introduce, the middle individual on the picture is Corey Knott. Corey Knott joins us from the world of from mortgages. He was a mortgage broker and had been studying financial planning and had worked with another competitive firm for quite a while, and reached out to a contact of ours, and after numerous conversations, we decided this is a guy that we have to have on our team. So Corey is our financial planner, and he is going to be not only helping deliver financial plans for our existing clientele, but we have built out a financial planning service that offers advice to clients that aren't wealth management clients. So we are now able to help a much broader cross-section of clientele do plans that connect to savings, debt repayment, advice around mortgages, just a variety of things that is needed in the marketplace, and Corey is going to be delivering that for us. The third individual is Asan Khan. Asan joins us after completing a master's degree in risk management from University out east, and he is now kind of straddling the investment management team as well as the operations team at North Road, helping us not only manage individual portfolios, but also helping us with the operations of accounts, and that connects with our custodian. Did I miss anything, Cary?
No, I think you nailed it. Happy to have those folks on board, and the team's much stronger as a result. Absolutely.
We've also been working through the delivery of the digital risk advisory program with our lead digital risk advisor, Misha, and we're making good progress on getting our clients through the program, all the modules that were developed for the digital risk advisory service. If you haven't been contacted by us yet on this service, get ready for a call. We're quite eager to get all of our clients through this program. We are getting very good feedback from you, our clients, on the information and the advice that Misha's providing, and quite happy to be really a kind of a world-leading firm in this area of advice.
And Marshall, one of the things we've mentioned on webcasts in the past, but we'll mention it again, and I've put up the QR code here that folks can scan. There's a free resource for our clients, friends, and family on our website where folks can go and take a really quick version of our assessment. It's not the full assessment, but it's about 10 questions, takes 60 seconds to do, and it gives you a good idea of where you sit from the perspective of digital risk. So scan that code, send it on to some friends and family who you care about, who you think might need help, and let's get them buttoned up as far as their digital risk as well.
Very good.
As mentioned by Marshall, we have this new service around financial planning where we've enabled the work that we do for our wealth management clients to be provided by Cary for folks that may not qualify for wealth management. And so we're helping a number of folks that have reached out to us as a result of Cary's expertise to do this kind of work. And last but not least, Marshall, the insurance side.
Yeah. So there's now 3 individuals that are able to provide insurance advice. So Cary, myself, and now Cary Knott. And this is now a growing aspect of the work that we're doing for clients in Alberta and British Columbia. We're able to kind of review policies, provide advice on if new policies need to be put in place. And even how this connects to tax management. These are important parts of the financial planning picture. We thought it'd be a good idea just to remind you, our clients, that this is work that we do, and we want to be brought into the conversation if needed.
All right, let's talk about 2025 returns so far. What a year, Marshall. I want to just tell folks, we are going to rip through a lot of visuals. So if you're listening to this, you're probably going to want to hop onto video. We're recording this live on July 22nd. We're going to do a recap of what's happened over the first 6 months of the year for returns, and then we're going to talk about a few of the things in the news. And I would encourage you, if we're going through slides quickly, to just pause so you can take in what the slide says. Turn us right back on as we keep talking, because there's lots of things that have happened in the first 6 months. And I may have gone a little overboard as director of research on the visuals, Marshall. So we're going to go through this really fast because I think it's really important info. All right, here we go. Let's start by looking at the things that have happened so far in just 6 months of primarily, I would say the Trump presidency was the biggest influence here, but there's lots that's happening. We are going through a technological change that I would say arguably maybe the most important change of our career in our lifetimes as AI turns into a bit of a boom. And lots of that plus conflict throughout the world hit this last 6 months. DeepSeek come out and we saw AI and technology stocks take a beating. Then we had the tariff situation come through on April 2nd. We saw markets take a tumble. Lots of questions from clients around what do we do about all of this? It feels like we're in a new world. Then we had what has become the taco trade, the Trump always chickens out sort of conversation that happened out of the Financial Times when he put a tariff pause on the reciprocal tariffs. Then we had some trade announcements happen. We had the downgrade of U.S. debt by Moody's, which was a little late to the game there because a few of the other ratings agencies had already done it. Then we had the tax and spending bill passed by the U.S. Then we had Israel and Iran conflict come up. So many things, Marshall, and that's just to middle of June, let alone the last few weeks when things have happened again.
Yeah.
Anything there, Marshall, that you want to touch on as far as just events that have happened?
Well, just a lot to digest, and it might feel that these are abnormal times, but I think review after review, we tend to highlight that there's a lot that goes on in the economy, in the political world, as well as the capital markets, and the way that we invest kind of supersedes the today's news to kind of the many decades of expected returns.
All right, so let's look at returns on that note. I think the surprising thing for most folks, Marshall, post-April and the tariff announcements would be just how well markets have done. So here we're looking at Canadian markets, large and small. We can see that in Canada, small outperformed large on that end. And then we can see that that's a difference compared to a year ago or even 3 years ago. And we are seeing nice returns, though, overall, despite that drop in April.
That's right. And just for clarity, like we do have exposure to small businesses where many kind of retail mom and dad clients would have very little exposure. So we like to see when small gives us a lift in returns.
Yeah, for sure. Value versus growth here in Canada, and so far in 2025, growth has been the outperformer, but that is not the case if we look back farther into the last little bit. So definitely some interesting shifts in markets so far.
Strong returns, right?
That's right. U.S. markets, very interesting year for U.S. markets. We're going to touch on this a lot throughout this presentation, but we can see at least over the past year, large companies have outperformed small companies in the U.S., and that's been pretty consistent. And we'll see this is sort of the anomaly compared to most geographies, but that small return in -7 in Canadian dollars for U.S. markets, I think would be a bit of a surprise for many folks, but also, disappointing for folks who've been holding small U.S. companies. And we're going to talk about U.S. markets a lot today.
Yeah.
Value versus growth. So the idea that overall U.S. markets so far in Canadian dollars, at least in 2025, basically flat, despite having good returns over the 1 and 3 year periods. Growth outperforming value, in particular, most of that being just in the recent past, as far as 2022 being a real value year. International markets, we see small companies outperforming large, very similar to the Canadian market. Value outperforming growth in international markets. So despite value not providing some form of premium in the United States, still working internationally. Yeah. And then emerging markets, large beating small in emerging markets so far this year, and growth slightly outperforming value. So a real mix as far as the factors that we look at for equity markets, but overall returns being really nice so far this year with that one sort of, for lack of a better term, blip in the United States.
Yeah.
Looking at momentum, using Vanguard here as the proxy for momentum, we see it's been a really good year for momentum as it has been over the last few years.
And we added this in as a diversifier to our, predominantly value-weighted portfolio, and I mean, it's delivered. So I'm happy to see
Absolutely.
that.
Yeah, me too. Okay, Marshall, let's touch on Canada versus the U.S. versus the globe. And again, this is in Canadian dollars. This makes a big difference. We're going to talk about the U.S. dollar here in a few minutes, but how we look at returns and the currency we use, because the U.S. dollar has moved so much against global currencies in 2025, this really matters. And a couple things I wanted to point out. So in green, we've got the S&P TSX. In blue, we've got U.S. and in, let's call it yellow, we've got all countries outside of the United States. We can see back in 2022, Canada was really providing some outperformance, even if it was negative, relatively speaking, it was really helping our portfolios out. And then in the last little while, you can see in blue, the US just skyrocketing with ChatGPT being launched and in particular, the AI boom driving US markets up. And then a big swing down around, partially through 2025 here. So we mentioned currency. This is the S&P 500 that we're looking at in Canadian versus US dollars. And we can see that in Canadian dollars, it's been flat, even though in US dollars, it's been positive and pretty significantly so. And we can see that currency has really made an impact for Canadians in their US holdings so far this year.
Yeah. So just to reiterate, when we deliver our reporting, it's always priced in Canadian dollars. So we are taking the businesses that we have in the United States, we own them in US dollars, but we're recording them in Canadian dollars. So it's priced in Canadian dollars. So when we have a weaker US dollar or a stronger US dollar, it impacts how we are delivering returns for our clients.
Good. So far in our presentation, Marshall, we've been looking at Canadian dollar returns for assets. Moving forward for the next few slides, I'm strictly showing in US dollars just to show the differences in how assets have performed in one currency. And we can see on this slide here, what we're looking at is the Russell 1000 technology in green and the Russell 1000 value in blue to give us an idea of the difference between value and growth returns. And it's really striking. In 2022, as interest rates were rising, there was some real concern about technology companies and their ability to provide future returns. Prices came way down in 2022. Value performed pretty stably overall, especially relative to technology. And then we see the big swing through the end of 2022 and 2023 as the AI boom starts to take off. And in green, we see it just dramatically outperformed value over that period into 2025, where we see this really big downturn and bounce back as a result of tariffs and some of the policy announcements that came out. So I know, Marshall, in April and May, I got lots of questions from clients around what do we do? It really feels different. Politics is different. Can we trust the United States? All of those kind of questions were coming out. And it would have been really painful if folks had sold out of the United States completely at that period, hey?
Yeah. And we try never to let today's news drive our behavior around how we own portfolios. We saw the results after the some of that bad news had to get digested through the markets and through.
Yeah, for sure. Interestingly, outside of the United States, a totally different story. So on this slide, we're looking at growth versus value outside of the United States. And blue is value here, and green is tech, as it was in the previous slides. And we can see really significant outperformance for value outside of the United States. So the United States, with its heavy tech sector and some of the best companies in the world being in U.S. technology, is really experiencing a very different market compared to the rest of the world.
Yeah, in this case, it's growth. So it would be just broader than tech, but tech takes up so much of that kind of ecosystem, right? With how valuable those businesses are.
Yes. All right, let's talk bonds quickly. Canadian versus U.S. bonds. Again, some real variance in our fixed income this year in markets. Canadian government bonds we're showing here, short-term government bonds, again, priced in U.S. dollars, just to show the difference between the bonds. And Canadian bonds have outperformed U.S. equivalents, at least in this chart.
And strong returns in this period. Very happy to see that.
Yeah, I think many people would be surprised that Canadian bonds had performed that well in the first half of the year. Marshall, what do you think?
Oh, absolutely. I mean, look at even the 12-month returns. 5.5% to 6%. That's those are attractive returns.
Especially when you look at the previous 3-year returns prior to that, when interest rates were so low.
Yeah, exactly.
Okay, lots on this chart, long-term versus short-term bonds. But in general, I would say a couple things to look at. With interest rates rising in 2022, long-term bonds here in red really have not come back to even as a result of higher interest rates, risk being realized there in long-term bonds, negative year-to-date for that index. Short-term bonds doing a little better, universe doing a little better, and then international sort of in line there.
And in our core fixed income holdings, we are not long-term bond holders. We are on the short side of things in a big way.
Yeah. All right, REITs, again, a very interesting story here. U.S. dollars, green shows Canadian REITs, blue global REITs. And in 2023 into 2024, we saw global REITs outperform Canadian REITs, but we can see year to date a real variance there with Canadian REITs outperforming so far this year, and global REITs being relatively flat.
Absolutely. I mean, there's a lot of disappointment in the Canadian REIT market and even the global REIT market. I mean, a year ago now, but we got rewarded for sticking around, and happy to see that.
Yeah, it always seems to happen, Marshall, where when we get really disappointing returns, the question from many investors is, should I even be invested in this thing, whatever the asset class is that is experiencing disappointing returns? And I think once again, we see that it would have been very disappointing if folks had sold out of these completely.
Yeah.
Okay, let's talk crypto. The vast majority of our clients, Marshall, are not interested in owning crypto. They've told us this, but I think it's really important that we take just a couple minutes to talk about crypto, because there have been some enormous changes, in particular in the United States, in just the last few weeks. So last year, exchange traded funds for crypto securities like Bitcoin were approved. BlackRock's Bitcoin ETF, exchange traded fund, now holds more than 80 billion with a B in assets, and it's the fastest growing ETF in history. Fastest ever to reach 70 billion in assets under management in just 341 trading days after it launched. So these things are really, really growing. In addition, New legislation in the United States, the Genius Bill, which provides some guidance for stablecoins, has been approved by the U.S. government. The Clarity Act, which provides legislative clarity for crypto companies, is going through the government now and being looked at. I think it's past one part of the U.S. government. So many, many changes that we're going to hear about a lot moving forward. And for index investors, for the first time in May of this year, Coinbase, a crypto exchange and a platform for holding and trading crypto, was added to the S&P 500. So index investors are now holding some form of allocation that is highly correlated with underlying crypto. Anything to add there, Marshall?
I mean, some amazing returns. It's a challenging space to be an investment advisor in, because the opinions are very strong on both sides of the argument. But without getting into the debate, just the numbers, 85% in 1 year on Bitcoin, 1,000% return over 5 years. Those are huge numbers.
For sure. What's not shown here is the huge volatility and the minus 75% returns and some of those kind of things that have also happened, right? Yeah. But I think it's something, at least for our clients, that they need to be aware of. From a peer education perspective, we're going to have lots of conversations in the news about what's happening in the crypto area of the finance world over the next few years with these new legislation acts coming through the United States government. Yeah,
I mean, I'd be curious to hear from clients if they want to know more, if they want to know why blockchain, Bitcoin, Ethereum, like what's the point of it all? We did a workshop on this topic, I don't know, maybe 3 or 4 years ago. It might be time to do it again. Be curious to know that from our clients. Let us know, please.
Yeah. One of the other areas that has really picked up this year, Marshall, and is in the news is gold. We'll touch on this in a couple of slides here, but gold up 25% year to date as per the attached, and this is as of April 30th, that number. So just a wild time for gold right now. One of the things that is very interesting, I think, for folks is, why do many finance professionals not recommend gold when it has these kind of returns from time to time? And this stat is interesting to me. 80% of the calendar years since 1970, S&P 500 is up 80% of the time. Gold's up 60%. So the sort of positive frequency of positive returns is less in gold, even when it has these years when it goes up pretty dramatically.
Yeah.
One of the things I found interesting, Marshall, that is being talked about as one of the reasons for the increase in the gold price is that central banks have been buying a lot more gold in the last few years, in particular post-Russia invasion of Ukraine. And so this chart, I think, just speaks volumes as to what the volume looks like for gold.
Yeah, I had a quick personal story. We were on a family trip to Ottawa, and just outside of Ottawa, there's a place called the Diefenbunker. So when Diefenbaker was our prime minister, there was a many-story underground bunker built, and my family and I got to walk through one of the vaults that would have held the gold that would have backstopped the Canadian economy back many decades. It was fascinating, like a huge vault, massive door. It was just really, really thick. And as a finance guy, it was neat to think like, hey, back then we actually needed to back up our currency with this stuff to provide its legitimacy. 2025, those days are gone. It's the full faith that we have in our government to tax and back up our currency is what provides its stability. But anyway, it's a quick aside, but I thought a nice quick story for history here.
Yeah. And, it connects to one of the topics I want to talk about, Marshall. So that ends our conversation around returns up to 2025. I want to talk about what's in the news right now. So folks, if you need a little break, press pause and come back. But I can guarantee you the next, 30 or so slides are really going to poke your brain as to what's happening in the news. So let's talk about inflation, Marshall. Many folks believe that gold is an inflation hedge. We're not going to talk specifically about gold for inflation, but I would say, at least from my perspective, to bring this from gold to inflation, I would say that it is an imperfect inflation hedge at the very best way to sort of think about that. Do you have any comments on gold inflation, Marshall, or should we just dig right in?
Let's dig in.
Okay. All right. Canada CPI change in the last 5 years. We can see that since 2022, when inflation was really high and interest rates started coming up, we've seen inflation come quite a bit down, which is great. One of the key things that's in the news right now is this little blip right over here, where we see CPI going up just slightly. So in the last few months, we've seen CPI go up in Canada a little bit. The question then is, especially with the carbon tax being cut back, is this a trend for the future? I would say, Marshall, at 1.9%, which is most recent number that I've got, that is a totally reasonable inflation.
Oh, for sure.
Yeah. We're concerned about the trend, but
I paid $1.15 to fill up my car this week. It's been a long time since I've filled up at that price. It has a big impact on kind of cost throughout our economy.
Yeah, for sure. That being said, many I'll call it pundits or forecasters are trying to figure out what the Bank of Canada does in light of relatively stable, low-ish inflation that has had a bit of an uptick. And Bank of Canada so far has come out and said, no change, watching the data, those kind of things. RBC recently came out and said they don't expect any future cuts. They're one of the few here we can see at the top. TD, Scotia, some of the other banks are expecting some further cuts. But I would say in general, the expectation is that it would be few cuts, if at all, at the Bank of Canada side, which seems to be in line with some concern around inflation and whether or not tariffs are going to drive inflation up.
Yeah. I mean, if tariffs come at us in a big way, there could be an argument where the central bank would want to lower rates to kickstart the economy, because that could be strong headwind against our manufacturing sector.
Yeah, the things that I've read, Marshall, just from an I shouldn't say economic, an economist consensus seems to be higher inflation in the short term with tariffs, lower inflation in the future as economics becomes depressed and the economy sort of has challenges, which comes in line with what you're saying. So I think Bank of Canada right now is holding steady, trying to figure out where is this going to go. Is it inflationary in the short term? Is it not in the long term? And they don't really have an answer.
Glad I don't have that job.
Yeah, be pretty thankless, right? Yeah. How does that connect to Canadians? Well, here we can see a report on Canadian mortgages set to renew through 2025, 2026, 2027, and we can see the biggest chunk coming in 2026. So for folks that are in that group looking at mortgage rates, maybe they got a mortgage in COVID at super low rates and are now looking at much higher rates than they're used to. This is something to be aware of, that we're, at least in the forecasts, are not expecting dramatically lower cuts at the Bank of Canada side. Yeah. That doesn't impact mortgages completely. Mortgages are more based on bond markets, but probably where we're at now is likely the best place to start thinking about what your next mortgage is going to look like.
Yeah, for sure. Like, this could have been really bad news if rates were much higher. If inflation was taking off, a lot of Canadians could have been in trouble on this rollover. A good place to remind our clients that if mortgagers are a part of your story, we want to know about it. We want to give you advice on the rollover. Let us know. Even if your kids have a mortgage, let us know, and we can provide some advice.
Okay, Marshall, the big question: is the U.S. in trouble? Dun, dun, dun. I have had this question from clients a fair amount over the last few months. And I would say just the nature of how much change we've seen, how negative the news has been, really is driving a lot of uncertainty and consternation. And so let's just recap what's happened. We saw the tariff announcements and big declines as a result of that in April. That drove a lot of the questions and concern. As a reminder, the initial announcement was expecting 30% tariffs, which would have taken the United States back to roughly the same rates in the early 1900s. And so just seemed like just a wild prospect at that point. Really bothered markets. Markets fell pretty significantly at that point. As of the end of June, discussions appear to be with no change at about 15% for tariffs. So a little more reasonable. We've had recent announcements saying August 1st, we're back to 30 if we don't get deals, yada, yada, yada. this is really a moving target. And I would say, Marshall, the fact that markets have bounced back and are no longer moving dramatically at new announcements are basically saying that they think deals are going to get worked out.
Yeah. I'm personally exhausted just reading about this every day.
Yes.
Like there's so much to read, and what is actually going to happen, and dealing with it, a man like Donald Trump that who knows what side of the bed he's going to wake up on, and how he's going to treat Carney in this negotiation. I just like it almost feels pointless, right? I'll read about it after, and we'll clean up the mess in 2.5 years.
Yeah, and I think one of the things that helps me sleep at night, Marshall, is recognizing that business owners and managers are going to adapt to whatever the end deal ends up being, right? Yeah. Whether it creates some pain in the short term, and for sure, people's jobs are being affected by this uncertainty. And that really, really is awful. All of that being driven by pure uncertainty. But I think at this point, we gotta hold on, we gotta stay invested, and we have to just wait for the fallout and see where we end up on the other side, and then move forward.
For sure. Commerce, capital markets, the economy, natural sciences, these are all bigger than Donald Trump. Like the world will move on when we're finished with this guy.
Yeah. Let's look at just markets really quickly here, this time in Canadian dollars, Marshall, and we can see U.S. markets taking a big tumble as a result of the tariff announcements. Lots of this, the result of currency, but thankfully, we are diversified across the globe. And I think one of the key things that people are wondering is should they be reducing their exposure to the United States? We're going to talk a little bit more about that. But I would say that this downturn in U.S. markets, despite the bounce back, was really driving a lot of that conversation. As far as the U.S. inflation, we can see the same thing happening now that we saw in Canada, a small little tick up in U.S. inflation. And that's driving a number of questions now saying, okay, is this the tariffs finally hitting? What's going to happen? What happens with inflation in the U.S.?
Yeah. And it's interesting to note the U.S. inflation is like double the inflation rate in Canada.
Yeah.
And you were reading about that in the news where, people are frustrated at increasing prices. And here you have their leadership talking about, dramatically increasing their prices further with tariffs, because the U.S. consumer is going to pay for that tariff that is added onto the products that they're bringing in from outside of the United States.
Yeah, close to 3% for the inflation in the U.S., despite being close to 2% in Canada here. And a big part of what's driving some of that, Marshall, is U.S. deficits. So I think many Canadians would be surprised to find out that the U.S. government is running a larger deficit than the Canadian government is right now. And so we see interest rates are higher in the U.S., bond rates are higher in the U.S., and a big chunk of that is because for the first time in a non-economic crisis, non-war scenario, the U.S. has a greater than 5% deficit being run by its government. And many people, I think, are really questioning this. Why is spending so high when there's no longer an emergency in the U.S. economy? And part of that is, as a result, the dollar is falling, amongst many other things. But that deficit and some other things is driving folks out of the U.S. dollar. So the U.S. dollar had its worst first half of the year since the early 70s. Really great chart here that shows how 2025 has performed versus other years going back to 1974.
Yeah, and that's a really cool chart. I like this one a lot.
Yeah. And as we saw earlier, a lot of that has really impacted our returns as Canadians. One of the things I think is interesting, Marshall, is that the US dollar in relation to other currencies has had long trending periods. And so some of the chatter right now is this downturn in the US dollar a longer trend, or is this something that's just connected to tariffs? And as we work through all these tariff concerns and uncertainty, will the U.S. dollar strengthen? And I would say I'm seeing information and research on both. But I thought this was an interesting chart to look at these long-term trends. Yep. In addition to that, what is very interesting is that historically, global equity performance has really been in line with the U.S. dollar. So when the dollar has been declining, we see that international markets have outperformed U.S. markets. And when the dollar has been strong, we see the opposite. And so it does have an impact on investments as to what happens with the US dollar. Okay. That's all the negative stuff, Marshall. Did I cover it all?
Well, we can always find more. So just add another hour to the webinar.
I think a lot of people, whether they voice it or not in the back of their brains when they're looking at their investments and seeing how well some of the markets are doing, the question really is, if the news is so bad and so down, why is my portfolio up? So let's talk about the opposite for a few minutes here, because I think we talk a lot about what we would call tail risks, as far as the unseen things that might happen that might drive down portfolios. But I think there's also this idea of positive tails. Like, what are the unforeseen things that might drive up markets? And especially in the US, where I think many Canadians are feeling really unhappy with the way Canada's been treated over the last few months. Why would we want to continue to invest in the United States? One of the things I think is really important to look at is the fact that the United States is almost 2/3 of the world stock market capitalization. So it is just a massive market when it comes to stocks compared to the rest of the world.
Yeah, and in the way that we've constructed portfolios, we have brought on a home bias. We have more exposure to Canada than we would using the market capitalization data that is presented here. We've done that for a reason. It's on purpose. So as a connected concept of that, we do own way less United States than say what a U.S. investor would own typically, I would say.
That's right. I think many Canadians would be surprised to hear that Canada is only 3% of global market cap. But even more than that, you look at China, you look at Japan, where these are very large economies by GDP, and their impact on world market capitalization is actually pretty modest. The United States, with its enormous companies that are some of the best in the world, is really gobbling up that market capitalization.
Yeah.
Okay, so we know the U.S. market is incredibly large, and we miss out on a if we don't invest in the U.S. markets. Why are the U.S. companies doing so well? Well, for one thing, they are once again nearing record profits. So profits have been just fantastic for U.S. public companies. These are really, really great businesses and driving lots of profits. In addition, profit margins are once again getting towards record highs. So profit margins are improving, not getting worse. And so that's driving prices. And last but not least, I would say that in the last few years, we've seen the AI boom really start up since ChatGPT was announced. And so this number just blows me away, Marshall. For the 6 large technology companies, this is Apple, NVIDIA, Microsoft, Alphabet, Amazon, and Meta, their expenditures on capital, so CapEx, have gone up 63% between 2023 and 2024 to $212 billion, billion with a B.
Massive.
These are just enormous numbers and enormous drivers of economic growth. So
Canada and the businesses in Canada, we need to learn, from the profitability and the just the efficiency of U.S. businesses. We are nowhere close in our country. It's disappointing that we don't have that same ability here.
Why is that much money being spent on AI? Some of it, for sure, Marshall, is taking that profitability and driving it into the next round of hopefully profitable future products. But a big part of it is just the fact that we're seeing enormous growth in AI products. So this slide looks at ChatGPT versus Google for searches. Hitting 365 billion annual searches. It took 2 years for ChatGPT. It took 11 years for Google. So ChatGPT is really coming up strong on Google and where Google's at. And the potential for the future for ChatGPT to eat Google's lunch, so to speak, I think is very, very, very strong. And so many of these companies are saying we have to spend this money. We have to be at the forefront of AI, or maybe it becomes an existential risk to one or many of these companies. And last but not least, from an economic perspective, to hit on your point, Marshall, this chart I think is really phenomenal. So it looks at patents connected to computers, or computing related patents. And in 2024 versus 2023, patents went up 6,000. More patents were granted in 2024 versus 2023. That's very close to basically all of the tech boom between 98 and 2003. So just an enormous amount of intellectual property being created that will eventually drive economic activity and growth. And prices are showing up as a result of these changes and these increases in AI. So this chart just shows that the top 10 companies have price earnings even higher than we saw in the 2000s around the internet boom.
Expensive businesses.
Very successful, very profitable, now very expensive businesses, right? Yeah. Marshall, I think there's a couple things to point out here. So post.com boom and bust, we see the other companies outperforming as far as I should say not outperforming, but the valuations being higher after the bust. And I would say at this point, to take these companies taking AI and driving it into productivity in the other companies is really the thing that needs to happen next, or we may see a real challenge to these valuations.
Yeah.
All right. So when will the AI boom turn to a bust? As our clients probably remember us saying, we have no idea. These things are incredibly hard to predict, as always. But I thought I would point out two things. One is that the volatility in tech is very large. It is with all stocks, but in particular, we can see just back into 2022 on this slide in blue, the maximum drawdowns that were experienced, Meta minus 74, Tesla minus 73, Nvidia minus 63, even Google minus 31 Apple minus 31. So we have to expect high volatility. If that capital, that CapEx spending becomes a problem because there's some sort of an issue in the industry, or it just this AI spending doesn't pay off, we can expect to see large volatility in these companies. And last but not least, on this side, one of the things I'm finding very interesting to read about is the amount of energy and electricity that is being captured by AI, especially data centers. So this chart shows what some expectations are for the total U.S. power demand that may come from data centers. So by 2030, they expect demand to change roughly from 6% in 2025 to 12% of U.S. power demand, total demand. So can we grow our data centers to the moon, so to speak, as far as electrical consumption? I would say no. So maybe that's the constraint that really hits these AI companies.
Yeah, there's an Alberta story here in terms of
absolutely,
a power center being built out near Lake Wabamun and other places in Alberta. It could have some interesting implications for jobs here in the province.
For sure. And I believe the regulators have stepped in to put a sort of a soft cap, so to speak, around future data centers being built until they can really get a handle on what this is going to look like for energy consumption here in Alberta, Marshall. All right, let's talk about all-time highs, because all of that has driven towards all-time highs in stock markets, and not just in the United States, Marshall. We're seeing really great returns in Europe and in other areas around the world. And so sometimes I think as we get to this all-time highs, we get two all-time highs in markets, clients and investors start to think, geez, when is this going to roll over, right? When is this going to end? Am I getting into trouble by being too greedy at all-time highs? And I think it's worth us just looking at some of the data around all-time highs. And one of the things that is really interesting is that all-time highs tend to cluster together. So I would say, Marshall, that one of the things that really comes out of the data around all-time highs is that you're in a bull market. You just got to hold on to the horns of the bull and keep riding.
Mm-hmm. Yeah.
Right?
Yeah. If we could figure out timing, when to get in and out, we'd be all over that. We can't do it. In my career, I've been rewarded with that idea of like not knowing. You've had better results by not knowing and just staying put. But in connection to that, we also are fixed income investors. So we don't have exposure to only equity markets. We have private assets, we have real estate, we have other things that are diversifying the portfolios for our clients to kind of take this need to be always perfect on equity markets and lessening those obligations.
We can see on this slide, Marshall, as well, that returns after all-time highs, looking at 1 year, 3 year, 5 year forward returns have, on average, been successful for investors. So, keeping a thought on the long term here, as far as our portfolios, not worrying too much about where our market's today, but focused in on our goals long term. And if we need to be invested, we need to be invested, and we need to capture these returns in bull markets in order to do that.
And that's what markets do. They make all-time highs, and they just keep pushing through. So it's something that we as investors just have to be comfortable with and used to, right?
Yeah, I would say a part of that, Marshall, as well, is the idea that we also need to be careful of FOMO. When we get into bull markets and we see lots and lots of opportunities for enormous returns, we looked at the Bitcoin returns earlier, it can be really common for folks to start trying to chase and use their greed to make more money. And I use that not as a pejorative term, just like, hey, I want some of those returns. And that FOMO side we talked about in January in our year in review, as far as looking forward. And I'll say it again now, that we need to hold on to the bull, and we need to ride the bull as it's given us all-time highs, but we also need to not try and reach a little bit ahead of it and fall down, so to speak.
Yeah, exactly.
All right. So I think, Marshall, we're almost at our hour. If you've hopefully that was valuable for you. We would ask that you think a little bit about somebody who may also find some value in this webinar and webcast. Send it on to them. Let them know that this was valuable for you. It takes a lot of time from our team, especially Josh and our team, who puts together these slide decks and these recordings to do this work. So help us out. Send it on to somebody that could really appreciate the thoughts and knowledge that we've got. If you're new to North Road, subscribe to our YouTube channel and get on to some of our other social medias. We're going to be releasing lots of content over the next many months and years. And so hopefully you'll find some more value out of other things in the future. Marshall, anything you want to finish with?
Yeah, just looking forward to kind of wrapping up the summer here. And I would encourage anybody that kind of made it to the end, if they have questions, if they have ideas for future content for webinars or semi-annual updates, we would love to hear what your ideas are.
For sure. Thanks, Marshall. On to the next one.
Thanks, Cary. All the best.